Good afternoon. This is Tom Alexander. It is Sunday, August 1st. Happy August. And what we're going to do in this video is sort of review some of the details in the report that you have received. You can do me a big favor. I'm going to start posting some of these things on YouTube. It would help me out a lot if you will subscribe to the YouTube channel below. There's a button. And if you will like the video, if you see something that you like. Again, I'm going to start using YouTube a little more to communicate with you on a more regular basis. So here we go. Okay, let's start with a look at the four primary U.S. trading indices. These are the futures contracts. And what is clear is that we're in balance in the ES and the YM. And as often happens, you won't have everything exactly synced up among the four. However, what is important and what we can lean on here that's similar are the parameters of what we're looking for going forward into next week. And if you look at my cursor here, this is the low of the 27th, and this low coincides with the low in the ES, the NQ, and the Russell. Now, these are session lows, and the YM is a little bit different. The low is on the 26th, but this low is very important. The low of the 26th and the YM, the low of the 27th and the ES. It represents significant pivot lows in the case of all four, and in the case of the ES and the YM, it's a balance area low. It's the extreme of a balance area. Now, I'm going to talk about the ES, but everything that I say in the ES in terms of strategy applies to the other three primary trading indices. And any significant move, they're all four going to move in the same direction. And a tell that it's not a significant move is if a critical level is taken out by a couple of them and there's no follow through by the others. That's a heads up that the big money is not in here. When there is a significant move to one degree or another, all four of the primary U.S. trading indices will be moving pretty much in lockstep, at least in the shorter term time frames. Okay, so as we head into next week, this is a very well-defined balance area. We had a little bit of an attempt to break to the upside on Thursday, which led me to believe, okay, maybe this is a false breakout trade. We traded down to the low extreme of the balance area, and then we managed to close on Friday right in the middle, at the midpoint of this entire structure. Now, this is an increasingly mature balance area, and we know that the market basically is always in phase and in a transition from balance to imbalance to balance to imbalance. So the next phase here is, there's a high probability it's going to be imbalance or a trend. So the key is a break of below the 27th, a break here. Now, a rote way to trade that is just say, okay, if it breaks this, I'm going to go short. And that will work over time. If you take 100 trades over a large sample like that, has a very positive expectancy, because there's an inherently positive expectancy with initiative trades, with trend trades. Now, the reality is that probably 2/3 of those trades don't work because it's a false breakout. So how do you know? Well, you don't know, but you can plan a strategy. Okay, I'm going to go short here, and then I'm going to watch the market. And if in the smaller time frames, and if the market in the smaller time frames stops and it begins making higher highs and higher lows, that's tell that it's a false breakout. Also, another general guideline is if we were to break below this level, the market should not retrace back more than about 50% from the break here back to the midpoint. Now, if it does, it's probably a buy signal. So a sort of a gross plan for next week is to be short below this level, long above this level, and your stop is here. But if this is hit, you want to immediately consider the other side of the market, because it's even more probable at that point that that will be the true direction. Now, if this seems complicated, it's really not that complicated. It's also covered in real time, tick by tick, in the live trade room for those of you that are live trade room members. Okay, so let's go over here. Same exact concept applies. You know, you have sort of a two-sided trade in the Russell. I'm going to talk about the Russell. It's a really important contract at the moment, and this is an extraordinarily mature structure. If the Russell were to take out the high from last Thursday, it could be very bullish. If it takes out this low, it's going to test this level very likely. So, but we'll get more into that in just a minute. Okay, let's take a look at the profile view of the contracts. Now I'm going to use the ES. I'm not going to go through each one for the sake of time, but everything that I say here applies to the other contracts. So, as I've said many times, you don't want to be a market profile trader. A market profile is a means to an end. It's not an end in itself. What you want to be is an auction market trader. You want to understand the natural auction market processes of development in the market, and market profile is simply a footprint of that. There are times where a profile chart gives a better view of market condition as defined by auction market principles than a bar chart. But there are times when a bar chart gives a better definition of market condition than a profile chart. So they're not mutually exclusive, they're both tools. And it's important that you understand how to use the market profile graph to get the information you need to determine market condition. Just putting a market profile chart up on your screen can give some gross information, but it really can't really fine tune. For instance, if I look at this structure, okay, that's great. You know, this is the July auction. It's that relatively Gaussian looking shape that we expect any chronologically defined profile unit to form. But so what? Okay, so what is we have to divide this out into its components, because the auction process is in effect in all degrees of time all the time. In other words, it's fractal. So when we split it out, basically what we're looking at now would be a bar chart, except instead of solid black lines, we have letters that form the lines. We can also clearly see now that what is important is this balance here. You can go back and look at the bar charts that I just showed. This is that balance area. So now we can see clearly, if we get below this level, potentially you're in an elevator shaft. And an elevator shaft is simply conviction. You know, we had an initiative move higher. There's only one party in the market that can drive a market directionally and sustain that direction. That's big money. Now, if we begin to trade back into this area, the big money is either going to defend it very quickly, or you're going to see a very sharp reversal, and it lends itself to this entire range being retraced rather quickly. If that were to happen, then really the only objective level to the downside would be the low of August that coincides with the high volume node from June. I mean, the low of July that coincides with the high volume node in June. Now, just because it trades below this level doesn't automatically mean, okay, let's load up the boat because we are going to here. No, that's not what that means. It means it opens it up. It means that there is no substantial volume on the horizontal scale over here. Now, you're going to have a lot of market profile people saying, oh, wow, look, we have all this area in here that's volume, and you'll see a volume profile that extends out over here. Well, that's where these people really don't understand the auction process, because conviction trumps volume. So this is effectively erased by this conviction. So what's most important immediately is the fact that there's so much conviction here. And if we trade below this balance area to the downside, it opens up this entire level. You can forget this. So that's what's going to be interesting next week. Now, what we have also seen is that, and what we know in all degrees of time, down to almost the smallest of time frames, the market has been in this torrid uptrend. The migration of value in all degrees of time, by any measure you want to make, is up. So the initial signal that something could be awry in the short-term time frame is a trade below this low right here. Okay, let's take a look at the Russell. Now, this is the RUT, the cash contract, and it is in a multi-month balance area. The symmetry of this is a thing of beauty. So here is the balance area. It basically began in February. So we have February, March, April, May, June, and July. We're beginning August right at the midpoint of this balance area. Now, I'm going to show you, and again, this is how you use the profile graph to identify market condition. It's not enough to just slap a profile, some chronologically defined profile units up on a screen and get good information from it. You have to understand the auction process. So let me show you. So if we take this and we combine this into what Don Jones referred to as a meta profile, what I refer to as a composite. It's a composite. Now you can see this is the July auction, and you can see where we closed right here on Friday. And it's right in this high volume node from this entire structure. Now, if I take July and I fold it into the auction, we basically have one auction. Here's the high volume node right here for the July auction. This is the closing price for July. Now we're about to begin the August auction. One thing I can tell you with absolute certainty, we're going to test or exceed the upper or lower extreme of this structure sooner rather than later. Every auction has three primary key reference areas: an upper extreme, a lower extreme, and then the high volume node. This is 25%, and that's how I have denoted the high volume node. The 67% value area is a nebulous, useless designation. The 25% high volume node is extraordinarily consistent in being a key reference area. A key reference area is an area from where you are expecting a greater than random sharp move relative to the time frame of the key reference area. So this is a multi-month key reference area. We're expecting a move of significant magnitude. Okay, so let's take another look at this. This is the profile view of this. Okay, this is the bar chart view of the RUT, the cash market. This is where we closed on Friday, and you can see we're almost exactly equidistant between the upper extreme and the lower extreme of this balance area. It's remarkable. It's really sort of neat. So in the short term, the key is going to be a trade above Thursday's high or below the low of, what is this? The 27th. Okay, so again, the 27th comes into play. So you traders out there, you can develop strategy. In general, you'd want to be long above 22.56. You'd want to be short below 21.70. And if that's a trade that's going to work, it's probably going to work pretty quickly. And you can use all the techniques and the strategies that we discuss every single day in the live trade room. But that's something that I will be watching very, very closely. I want to be long above this level. I want to be short below this level. So this contract is, I mean, it's quite remarkable. 6% to the upper extreme, 6% to the lower extreme. Now, if we take that 6% just for fun, let's see what 6% from here up or down would be in the S&P. Okay, if we take 6% up or down in the S&P, if let's just hypothetically say it moves exactly the same percentage as the Russell, which quite frankly doesn't have to happen. to one degree or another, if there is a 6% move in the Russell up or down, the other three indices are going to move some percentage. It's unlikely to be 6%, but just for fun, let's just see what 6% would represent up or down in the S&P from Friday's close. Now, this is the cash market. This is the SPX. So 6%, that's about right. That's about the same. It was 6% plus. And then to the downside, let's see if I get it. There we go. Okay, close enough, right? So let's see what this is over here. Okay, that's about 46.63 to the upside, or 41.15 to the downside. And this is just sort of a thought exercise just for fun, just to see what happens. And if and when the Russell, and it will, it's not if, it's when the Russell trades to its upper extreme or it trades to its lower extreme, we'll go back and revisit this just for fun and see how the correlation between the Russell and the SPX turned out. Okay, now we get to a really, really interesting chart. This is the SPX, cash S&P, and below it are three very, very simple indicators. So this is a 10-day moving average of NYSE advancing issues. This is a 5-day, the green is 5-day moving average of advancing issues. And the blue line is breadth. It's NYSE advancing minus declining issues. Now, as I've cautioned many, many times to people that have been listening to me over the past 35 years, I've used this most of my trading career. And it is extraordinarily consistent and effective and can be a really powerful decision support tool, especially identifying lows, not so much identifying highs. Now, in this market off the March 2020 low, we have one of the more extraordinarily consistent patterns that I can recall. And I put this in a report a few weeks ago. I think it's actually, if you go back to the report, it's in the first report. I have it a link to that report, but I talk about clusters of these identifying intermediate to short-term lows. And then after you get a cluster of these, what will happen, a trend will establish itself. And within that trend, then when breadth reaches, and it will do it periodically, you will have breadth reach negative 2,000 on a closing basis, and that will almost always mark short-term important pivot lows within the trend in effect. And you can see here we have this extraordinary run of higher highs and higher lows, and the pivot lows coincide in every single instance with a breadth reading of negative 2,000, or in some instances, there's a test. Now, what was extraordinary on this last one right here is that price and breadth coincided absolutely almost at the same tick. And it just shows what an extraordinarily bid market this has become. In each one of these others, there was at least a test, even this one right here. Okay, so this was where we made the momentum low. Then it was a severe test right here. Well, this no test, it was just straight up. So what we want to be watching for going forward is at some point in time, we will break one of these levels, and that will be a real heads up. Now, as we head into next week, something to keep an eye on, if we do get some sort of selling into this range in here, and that selling coincides with a breadth reading of negative 2,000 or greater, and we're in here, then we have to be alert for at least another short-term low. That's what this is telling us. Now, the ensuing rally off of a situation like that, and I don't want to get too far into projecting things, but that ensuing rally will be extraordinarily important. And if we do get down to negative 2000, I'll do another update like this, and I'll post it for you. So guys, I hope you have found this helpful and useful. If you did, again, I very much appreciate it if you would subscribe to the YouTube channel and you would like this. Have a great weekend. Next week should be fun.